Welcome, it's the Market Sniper. That's right, also the Crypto Sniper and Reset Sniper coming at you in a data-heavy week. What we're going to discuss today is the fact that there is a data-heavy week. There's two kinds of data. There's the Fed. What are they going to do? What are they going to do with interest rates, which is going to affect currencies, dollars, and everything macro. And then on top of that, there is the equities. The tech-heavy equities particularly are talking, but it's not only the tech. This is an earnings week. Very rich with earnings. So we're going to have an earnings rich week. And what does that typically mean for you, the trader? You could be in crypto only and you think, why do I even need to watch this? Because the risk on, risk off vibe is going to take direction as a result of what happens with the Fed and what happens with the tech market. We've shown before that Bitcoin is a kind of high beta proxy of the tech market. So those that are in crypto will keep interest. If you're trading equities, this is going to be a very directional week for you. And also the indices are going to show us which way they're going to go. Currently looking a little buoyant, but there's real risks if you chase this fool's rally. And generally, when you get a recession, you have at least 15-20% more downside potential than we're at right now for equities. That's on the big caps. Some of those smaller and medium could lose more, but it depends who's overpriced. So before we do that, let's talk about the big Fed, the money, the chief Satan. That's right. I will pivot and show you a quick chart that will show you why likes of Stanley Druckenmiller and others have said, listen, if we go over 5% on CPI, high. Yep, if you go over that, you're almost invariably going to have to raise rates higher than the CPI number, must go higher, and it's followed by a recession. So let's show you that image right up top here and join me in having a little look. So what are you seeing? It takes a while to focus in the eyes, eyes, look into the eyes, look into the eyes. The blue is the effective Fed funds rate. The blue line is what the Fed has done in terms of tightening and shortening. The red line is the actual CPI, which is the measure for inflation. And then the horizontal red line is the 5% mark. So that is perceived as a really getting out of control inflation rate. So we'll grab our pen and we will scribble and draw like a child, and we'll just show you a couple of interesting and amazing moments. We'll go with orange actually maybe. So the 70s recession. 1971, we all wonder what happened in 1971. Yep, some of you know. Leave a comment if you do. What happened in 1971? So what happened? Effective fund rates went up, and you can see over here that you were above the 5% mark. Let's go with black actually and a fatter pen. That's a little bit weak and watery. So you can see you broke over there the 5% mark and you were going up there, and the rates had to go higher than the CPI to bring it back down below the level. That was one instance. Then we went into 73, 75. So that was the tail end of the Vietnam War, the knock-on effects of 1971. France asked for their gold back. Oh, that was most rude of them, wasn't it? When we just unhook that relationship with backed by gold. Remember that thing? You could actually collect your gold. That was such a barbaric old relic, wasn't it? Oh, so glad it's gone. Let's just go full float fiat system. And now you find yourself where we are today. That's right. That's what the criminals did. And this was, of course, very strong level of inflation, CPI. So 5% down here. You must have been in and around double digits then. And then they thought, we won. They upped the rates. You can see the rates were a bit higher still, brought it crashing back down to 5. And then she bit again. That's the key thing. Once you've gone, inflationary, it doesn't go away. It's a monster that keeps needing hammering. You have to drive the wooden stake through the vampire's heart. Up it went again, and then you got ludicrously high rates. Many people have heard about it, weren't born or around. I remember it, I was a much younger man. And you'll hear that during that period, that was the Volcker peak rates. And he cleared out a lot of bad investment. A lot of businesses went bust, a lot of bad investments. You literally had farmers in New York in their tractors doing the French gig. You haven't had that ever before in the last 40 years since. And as a result, the Fed rate came down, inflation well below 0.5. And then we had the Goldilocks Greenspan event. the Goldilocks Greenspan, where he said, we have this a new productivity miracle, he said. We're all just suddenly so productive. He didn't think about the boomers. He didn't think about globalization and all of that. He just thought everybody got a whole bunch smarter. We can afford to run lower interest rates and just have asset bubbles because there's no inflation. Your bread price isn't going up that much. Your beer price isn't going up that much. And we had this lengthy period. Let's do it again. Let's go maybe with a box. This lengthy period over here from there, where essentially you never looked at 5%, apart from one key moment, that's right, 08, 09, which was actually the run-in of 06, 07, when property prices were running, everybody was getting a car loan out of the good old house, the ATM house price value, and leveraging up a bit more and changing their car every 18 months and taking, more holidays and doing more stuff. Well, we've got a bit of an inflation bump then. And these gray bands, by the way, guys, these gray bands are clear-cut recessions. Now, what I want to highlight actually about that is you never properly come out. When you get these gray bands and you've really overdone it, you actually go in and back in again. So you come out and then you went back in. You saw it 70, then you see 73, 75. It's not like you go into an amazing recovery. What actually happens is you keep bumping. You stop being above 5, but it's a technical minor level below 5, and then you go back above 5 again. So this whole period was stagnation, generally. Right the way into 82, that big box that I've just drawn was a period of stagnation, real stagnation. Very low growth. So the fact that you think these bands are quite thin and that's only the miserable. Remember, the technical recession is 2 quarters of negative growth. So what that effectively means is, we've had 2 quarters, and then you get one, which is 0.1, and then you go, that's it, end of recession. Well, it's not. It's a shit growth, basically. Shit growth off a very low base compared to, so you get basing effects because you're comparing it to a quarter previously that was already exceedingly low. And even if you flatline and you get naught, it's like, hooray, we're not in negative again anymore. You don't celebrate that. That's not good times coming back. So that is an entire period of stagnation. And this is what I fear is coming over here. Don't forget, 82 to literally the modern era, the peak bonds, 2020. So 82 to 2020, you literally had 40-year buy the damn dip equities, buy the damn dip bonds. Now, there were some sexy dips that did hit you, it has to be said, but generally you got into an exponential equity market based on a demographic boomer bubble that were investing. Bill Clinton's era, you had peak surplus, in fact, because the most productive people are around 46 and a half years old, and as a result, your boomer generation was flying. So we're going to leave that, but I wanted to warn you that as we come into today, the key point you want to look at is how much you've surpassed the 5% mark recently. And in actual fact, that's quite substantial. And this is what I would imagine is the first stab of many above that level. And guess what's been happening in America, my American friends? Your dollar has been throwing it down as faster than it actually went up. So that means you are re-importing inflation from your Chinese supplier, where the yuan is held up better, or the renminbi. We'll be showing you that chart and a head and shoulders we gave you quite some time ago on the USDC and H. The euro's now back up at 108s. Mid 108s. So what does that mean? That means things that were cheaper, Mercedes-Benz, BMWs, wines, etc., are now getting more costly. Anything manufactured there are now getting back. So where America, by pushing the strength of the dollar, exported and pushed some of that inflation out into the other nation states, as that dollar comes back down, it's coming back in. Plus, then you add the challenge, the petrodollar unwinding, lots of things. There's a lot of potential downside, a lot of potential stagflation to come. And this could be hyper stagflation because it comes on in an environment where there isn't high growth, and the Federal Reserve is committed not to do the same degree of print and play, because they were late to the inflation. They denied it. They looked it in the face and said, you're not real, you're just passing through. And then they carried with every single possible story. And then eventually they acknowledged. And once they acknowledged, it was too late. The train went left and now pumpy. So we want to show you how fast that has actually gone up relative to previous hiking cycles. How fast it's gone up. It's gone up steeper even. Let's see if we can make that any bigger. Whoopsie. Let's go bigger. There we go. I want to show you that it's gone up even steeper. Let's get the most modern history just in view now, and I'm going to zoom right in. It's gone up even steeper than it has in the 3 previous rate increasing cycles. So if you have a look at it here, that was the steepness there, that was there, that was there. That was your rate steepening. That's the blue line we're circling with a pink pen. And this is how fast it's gone up now. And that was the runaway rate of that inflation, which was, of course, far faster. So because they got off so late, they've had to go really fast. So the lagging effects of those interest rate hikes have yet to come in. So what does this mean for the equities, the people that are reporting? Let's leave this chart be and let's move on and go to what we've got. Well, there's an interesting article in Zerohedge, and the key strapline and heading is recession forecast at odds with bullish formations. So what's actually happening is right now on the technical side of the indices, you are actually getting a recovery look in terms of upside. I would not be racing in to short that. By the way, that's made a head and shoulder downside target. It's in what we would refer to as a progress decay. Target made, so the short is there, you capture it there, good trade, good line of efficiency, that amount of time in trade, that amount of sell, 13,000 down to around 10.4. Good trade. Okay, all very nice. But what's happening now is the reason a target is because it's no longer it's the most attractive place to get out. That means the easy progress to the downside is not likely to follow. You're going to get rallies. You're going to get a lot of time extending. So people who bought options are going to sit around waiting for something to happen to the downside. It's not going to happen. In fact, the market may move against them. And I would argue you've got a rising wedge here on your tech heavy guys. It broke down, failed to make a new low, and now you've made a newer high. So what you're actually getting is a bit of swinging around. You've certainly had the volatility. It's now calming, and that's proven by the VIX, which is going down. So the VIX is a volatility index, which is just above our lovely Nasdaq. Let's show you that. It's going down. That means the market is very relaxed. It's so relaxed. It's not worried. There's no worries in the world. Good old Fed. He's chilling out. He's going to be slowing down. We were pricing possibly the likelihood of a bit more, and it's not happened. So what you have is a benignly relaxed VIX that is saying no issues here, nothing to worry about, which is actually quite bullish for the indices. But you've got all of these real indicators, 10% layoffs in many of these major tech companies. Those are people that go from having jobs to burning savings to keep going and needing to find new jobs somewhere else, usually lower paying. Anyone who's hiring in this environment is not overpaying in terms of salaries. There'll be quality people to choose from. So it's a much keener and a much tighter market. Plus, those costs of things are still super high. So the notion of inflation going down, again, remember the basing effect. They compared year on year. So as you're comparing with months more recently, and less old months where they were low and inflation was only just being deemed to be coming up. Now you're dealing with higher inflationary months. The rate of inflation might actually be dropping. But that doesn't mean your goods are getting cheaper. It just means you're not going up as fast as you once were. So that's not progress, really. And people are as expensive as they've ever been. And they'll continue to get more so. But maybe the rate at which they do that might not go up quite as fast. So VIX is relaxed. We feel almost a little too relaxed. But nonetheless, the major indices are showing some degree of calm. So we showed you the Nasdaq. We can have a look at the SPY. Again, high period of volatility. This is your volatility and your uncertainty. That box over there. And actually, it's subsequently been calming down. you can see it again, another inverted head and shoulders. So this was during the period that our friend Hunter was saying everyone should go long. We were here and we were saying, no, head and shoulder, go short, take it to the target. Now that's played. Now it's new stuff. So now we're almost half a year later. So we've gone from July 2022, where we were disagreeing with our friend, to now actually you're getting a kind of bid. You're getting a kind of bid here, and it's calming down. The swings are smaller instead of that. So that illustrates loss of volatility. Now, the dangerous thing, and people will say even on reducing earnings in an inflationary environment, maybe people are chasing the asset because they think, well, it's going to give me some earnings and it'll also give me future dollars, and everything else is costing me. The cash in my bank is losing value. At least I get an income stream, so I'll overpay now. That's where I'll choose to park my money. The problem with that is the US is one of the most expensive markets, and the recession is indeed here. As far as I'm concerned, it occurred when the 2 negative quarters occurred, because that's the definition. The fact that they chose to change the definition is a big no-no to me. I'll keep being a nodding head, because that's the definition. Stick to it. They're also going to be changing the measurement for CPI. You see how you get the number you want? You just remove the basis of comparison with previous numbers and muddle it up. You muddle up the water a bit and make future comparison more difficult. And guess what? The new measure is going to make it seem lower. That's way I can steal with you and it's less apparent. I can steal from you and make it less apparent. I can say, I don't know what you're complaining about. Inflation is very low. It's at a low level. This is the game. This is the potential game. So let's have a look. So indices actually could go up short term. Does that make it a good play and a good game to jump in long now? Well, it's a little bit like catching and collecting 5-cent pieces in the fast lane of the Autobahn. You may get some return and you may get away with that return, but at some point something very quickly could come and smash you for a 6, and those 5-cent pieces you picked up in the fast lane could look like very expensive broken spine repairs, because it could come quickly, it could come suddenly, and it could hurt really bad. So for me, I would look for little rallies and push-ups, more to get puts and more to get potential shorts, because the pain will bite, the lagging effect will start to kick in of the existing interest rates, and the inflation will be coming back to America. To my beloved American friends, welcome to you all. Check in. Where are you from? What state are Americans? And of course, our friends from Europe and everywhere else, tell us where you're in and what you're checking in from on the live stream. Why aren't you working? Why are you watching the sniper? He's a bad man. The algos say so. Anyway, so let's go on to the earnings. Who's reporting? This is the important thing. So the corporations, who is going to be reporting? So you have AMD. I tell you what I'm going to do. This is my offer to you. I am going to give you the option to tell me which of the major reporting equities you want me to have a look and analyze. So you have AMD. You also have ExxonMobil, Rockefeller Oil, of course. You have Pfizer. Oh, sweet. Aren't they lovely? Wouldn't it be nice for them to have an awful number? Caterpillar, General Motors, Snap. I don't take Snap too seriously. Is there people still on Snapchat? AMZN, Marathon Petroleum. So quite a bit of energies. And then we also have tech companies. The tech companies that will be reporting, and I suggest that I should do at least a handful of those. So Microsoft, Google, Facebook, and Amazon. So why don't I start while you guys put in from that other earnings, you choose some other equities. I will do Microsoft, Amazon, Facebook, and Schmoogle. Everybody always overcouples Apple, so definitely Amazon and Facebook, and probably Microsoft too. So let's go and have a look at those. So equities for reporting. Sometimes you can see things on how they're likely to go. Here's the earnings. You can see the date is coming. By the way, before we, let's stay with Meta. You can see the gaps. HVF Method, yep, beautiful little upside HVF that made target up there. It was the last time there was anything positive outlook to have with our friends in Schmuckerberg and his Meta humanism, whatever metaverse game. So you had a broadening structure there, and then it just gapped through the funnel, invariably earnings driven. Isn't it interesting how the technical funnel, though, has hopped over? Super interesting. I mean, you could drive a truck right through it. It's a motorway through that, and it gapped right the way in. So it started to disappoint early, Facebook. It was one of the ones that got a beating. And then the last earnings in November, it took another beating again, but this time that gap has been closed on an upward trade. So now you are coming into the new year, and you had an exhaustive sell right down to 88. By the way, I've got this in log scale, so please understand these are much bigger moves than they look. Log scale for the big time frames, 380, 88. That's some drop. That's almost $300 out of 388 equity. So this is what you would call a proper puke. Couldn't happen to a nicer guy. Anyway, so that was Facebook. However, the gap close looks like an exhaustive gap. So technically you would often say that's an exhaustive gap, final low, especially if you rally and close it. So that's your initial gap over here, which is the beginning of the big ugly. You would still could have shorted. I mean, the funnel was at 286 to 253. It's a long way down to $88. So that's your initial gap. It's called the breakaway gap. Initial or breakaway. I'll just go breakaway gap. So you've actually got a beautiful technical set of criteria. Now, the whole point is if we go for demand destruction, this could actually just have a rally period, but we could reassert and make further lows possibly later. But at the moment, indices look like they want to creep up. VIX doesn't seem concerned. It seems like they're going to keep things ticking. They're going to keep things ticking like they're going to keep the band playing. We've hit the iceberg, but don't let the band stop. That's pretty much how it sounds in terms of the view on equities. Equities, remember also earlier on in previous year, 2022, we had the indices the volatility on bonds move, freaking out and saying, there's a big ass problem. And the equities guy saying, party on, but get me a couple more pina coladas there at the bar. It's all good and great. Let's keep going. So there was a sort of, hold on, these things are very economically relevant to the overall structure and sustainability of the entire financial system, and you're ignoring it. And guess what? They eventually had their sell-off. So they had the worst year last year in the end as a result of that. So that's FaceAche, and it looks recovery orientated, short, possibly short medium term. But be careful. I wouldn't rush in. The other key point on this, before I get the next one up, is you should always avoid trading an earnings news event. You do not know what might be coming. And it's a dopamine seeking gambler's activity, trading a news event, and the insider money may have already priced it in. And before we do the deep dive on AMZN, I will show you that very point on, you guessed it, Tesla. We're not going to do a deep dive. We mentioned it last YouTube. But look how post, and this is the value of targets, HVF method and the value of targets. Yep, if you like the value of targets, you can feel free to give us a puppy lick right now. Get short there and there. The market priced in the disappointing earnings outcome. And in actual fact, if you waited for the number to come in, as it eventually did there, let's move the chart a little bit across so that you can see the earning. It's actually rallied substantially since. So you could have got out very close. It almost made 2 digits, like it was $101. Now $173. That's huge. That's almost like a 70% recovery. There's that miss on revenue. 351 million in car sales that didn't happen. But they found a way to goose the earnings a little bit that compensated for it a bit. And guess what? But the market was pricing that miss in well in advance. So the sell leg, remember always, the markets are discounting mechanisms. If you're just thinking you can drive this far ahead into the mist, you're going to have yourself an accident. They have an opinion on what's happening well before it is going on. So they'll be monitoring. So that was your beginning of your sell-off. That was your sell-off for that miss for Tesla. This is the rally plus a breakaway or an early gap there, I would say, potentially for a rally up to the upside. And you could come back to your original neckline as part of a revisit. You could. I'm not saying you should. You deserve to. I think it's hopelessly overvalued, but it is Rockefeller cars, remotely disabled, battery, your mobile iPhone vehicle, which they can track, collect data on, and take over control. That's what they want to do. That's what they're going to do, and they're going to make it happen, and they're going to make it a pumpermental share, and it's probably very heavily owned by BlackRock, etc. Let's have a look at your comments. Barry, been there, done it, Sniper. Yep. Buying a good semiconductor company sounds like an idea for someone. So that sounds like a pitch for AMD. So I will be referring to my support team in terms of which ones you wanted to look. So let's go back. Let me just do Amazon first, because this is your new world online one-store retailer. Give your money back to Rockefeller. He was the man who was famous for having all his staff buy all their goods back in his own shops, that he kept them in compounds, the kibbutz communism that is so familiar. But capitalism has failed you. Competition and free markets have failed you. I'll be sure to tell you if capitalism ever breaks out in this cronyist world of ours. But anyway, so that is Amazon. You can see I've actually drawn a sleeve. Let's go a bigger time frame and do this one deeper dive for you. In fact, can we squeeze the monthly in here? This is quite some fallout of a sleeve here. So we are on a log scale, big chart. This captures the 2002 lows post.com. This, of course, was when Amazon went from the equivalent at the time of about $107 to $7, that correction. Since that period, the .com, that's right, including the great subprime crisis, which brought on and about that amount of sell, you've actually had a channel that has been pretty well respected all the way along, capturing the highs over there, the lows, and then the medium gradient, which is our splitter, all the way through. You've fallen out that multi-year, that's right, 2002, a 20-year channel. You have fallen out a 20-year channel in terms of growth. So the retailer's death is real pain to real pain to the equity that is Amazon, that relies on you having some money to spend and buy. And there it happened right there. So we'll go in and we'll have a little look at that piece, recent piece of the end, but it's interesting concept monthly for you to understand that. Is that an interesting concept for you to understand? If you found that useful and you're enjoying the equity updates, smash the like and don't forget to subscribe and hit that bell, because they will not notify you if you don't ask them to. So we go back to the more recent price action. We'll do it on the weekly first and we can drill down. Again, we saw head and shoulders. This is why we were deeply concerned. We aim to save people from making bad decisions. And that's why, as I say, we took a little bit of umbrage to the stock market's about to go up 60% as we were seeing all these head and shoulders forming. And we said, hang on, these people are going to get rinsed if they think they're going to get a 60% in the next 4 or 5 months during this period. As, yes, cranky left shoulder, head, and cranky right shoulder, all on $145. You'd hit a high in and around 100 and almost 90, 185, 188. And next thing you know, you get to trade 80, just above 80. That's quite some sell-off. That's more than 100%. You've dropped $100. And even at the 145 mark, if you shorted over here or at the takeout over there, you would have in fact saved yourself a lot of pain. Or if you'd sold just as an owner, you would have saved yourself a lot of pain, and you could be buying even now at 103 and you would get an extra share for every 2 shares. Because you would have sold at nearly 150 and you would be buying for just over 100, you will get for every $150, instead of getting one share, you would actually get halfway to the next share as well. So that was quite prominent. And this head and shoulders, note how you made the target, and then you actually got a rally all the way back to the neckline, and then you got a second stage. There's a real gap there. So let's just highlight that. There's a real gap. Again, gaps are earnings driven. Invariably, news events for equities. This is a special alert. It took me a long time to realize this and trade that. When you see gaps, you should expect fundamental information that has occurred. Gap, earnings, dip, then this was funky. It was trying to price in. You got a gap, earnings. Can you see that? So it's fundamental data that often will drive the update. So the market starts drifting on the last information. That last information gets a teeny bit stale. People are wondering, well, how's it going with the business over the last 3 months? And then suddenly they get a heads up and it wasn't going so great. Or they get a heads up and it was going great, and they reprice. So it's like you're getting points and then you're having to drift on your own steam for a while until you get a new data point. And people can drift in the wrong direction. Markets can drift in the wrong direction. So Amazon looks like a recovery play at the moment for a bit. But let me just remind you of that monthly chart. So it could be short term up, but long term, you have come out of your magic channel of the post.com. So you can get a bit of a return move, fair enough. You can get that little bit of a return move, but longer term, it could be more downside, and short term you could be okay. So be careful, be careful, be careful. Don't chase every penny. Possibility of this visit, if you were to get a little bit, so you could scenario cast here, little bit of a left shoulder. If you get back up there, that could be a head, and you could get a small dip, and you could end up with a 104 neckline, and you could get an upward projection, and that could even take you from 80, you know, and you could get another 20, you could end up at 120 somewhere, but that doesn't mean you're out of the woods because of those fundamentals and the fact that those recessions keep coming at you when you're as indebted as we are. Like the 70s period, only worse, because in those eras, we didn't have the same debt levels and we didn't have the entire globe in a similar situation. You could lean on international buyers. So good. There's 242 of you watching. So those earnings, let's show you those equities that you could choose. I think someone had a bid for AMD, a good chip company, so I'll do AMD. You leave a comment and my support team will pick out 3 or 4 other equities on the earnings front that you could have a look at. Here's the whole list. You can write them down. Hawaii. There's also, yeah, let me see. There was another list. Let's go do AMD in the meantime. So chips. NVIDIA. Yeah, we'll do NVIDIA then. Let's go have a look at NVIDIA. We'll do it first and then we'll do AMD. NVID. So always remember, guys, go from your macro to your smaller time frames. An interesting one, obviously a great grower since the 2000 era. We're going to keep it log scale. In spite of this being still in log scale, you had a real crank of growth during this period. Look at that. That's unbelievable because this is log scale over here. The values were just being knocked off. You don't have the same neat sleeve like you did from Amazon. This was super low volatility. And whenever you grind in a super low volatility period, it can often be a setup for major upside action. Low volatility, generally bullish, except certain pattern structures in the bear formations. So there are exclusions for that, but generally bullish. Look at that, what it set up. Then, of course, the events of 2019 took it on a little bit. Didn't sweat too much on the needlecrafty event. Did have a dip, but we are looking on a monthly time frame, so it is suppressed. And then continued on up, made 340, now at 195. So that's your macro story. There isn't a sleeve that you can put this in because it's just been too strong, even on the log scale. So it's been a great one, but more recently it has floundered. So let's have a look at it. So the interesting thing about this structurally is, even though it was pulling back, it was pulling back and retracing in a very organized way. It was never an absolute out and out capitulation. It's begging you to draw the basing descending grind line that it was over there. So in spite of all of that problem, it was begging you to draw. You also see key events where you have basing ascending grind lines that take you into wedges that lead into that such events. You can see the value of HVF method theory, by the way, in terms of grind lines. And if you want to learn more about that, literally go to themarketsniper.com, book a call, and you can do this for yourself. What else can we do with this? Well, you kind of had a broadening structure to the downside. We do the splitter, so that was a half move, and you've gapped through that. So that points to us that the bearish sell-off period that commenced from there is probably over. So there will be some upside. It's a dangerous kind of upside to chase, and volatility could return quite quickly, especially given that we've got a Fed week. Maybe the bankers have wink, wink, nudge, nudge, and Jay's said, no, it's definitely 0.25. There won't be any shocks or surprises. Don't forget, he was talking very bearish, hawkishly about inflation, which is kind of potentially bearish for growth stocks particularly. But that is a breakout out of a descending broadening structure and points to the potential of a degree of recovery, that the worst might be over. However, it is on a gap, which was probably may have had an earnings outcome. So you often can get gap closure first and a return move to the descending capping grind line of that structure before maybe going up. And you could also just churn. It's not enough to say it's going to be a ripper here, but it's no longer a sell-off. That sell-off peak low over there that came in October, the subsequent move has now undone that bearish structure for the time frame in review weekly. So remember, technical time frames matter a great deal. So that would be the analysis on NVIDIA. Thanks for your suggestion. It was actually quite interesting. Haven't looked at it in a bit, and that was as everything freestyle. I'll have a look at it on a slower time frame, just super quick. Higher highs and higher lows. It's all pointing for the lower time frames generally up. But it is a little bit peaky right now. Okay, what else you got? AMD, somebody had wanted, so let's do one of the tech heavyweights for you there. Then I'm going to give you an update on a Forex trade that we shared after we were all in, after it had begun moving, so you only got in later. That was the Euro Norwegian Krona. And I'm also going to take you into the Chinese yuan versus the dollar, because the dollar is going to be a big part of this. The dollar will be a big part. So let's have a look at the chip maker. This one I seem to have done some drawing work at some point. So AMD has been a little bit putting the wind up Intel sales. Intel has been pretty awful for a chip maker. And as a result, AMD has been creeping in significance. Lovely base out over here. So 2016, very easy. Let's do it from there because that's quite some time. It wasn't doing too much. It was second tier in the market for a long period, but it is clear flag, clear move up. Then we had the 19 shock and surprise. And since then we've gone up. Now it's had similar like NVIDIA. So you're going to get a lot of commonality by category. The ratings of these equities will adjust, and they will adjust according to how the market sees their overall industry as well. So you'll see chip and tech companies all going down often on a similar day. But you can see here as well, there was a degree of containment at the rate of descent. It is probably just at the foot of its broadening structure. It was slightly less volatile, but is probably about to leak its way out to the upside through the capping descending grind line, that double line one. So good progress, but is it a setup? No, I'll show you one that was a setup, and that was our FX trade. So Euro NOK. So we've been talking about, we're not quite sure why the Norwegian Krona was doing so poorly. Was it oil that came off a little bit, or why? Why are these things happening? So we'll show you a trade we shared just with a simple chart after it got set on its way and everybody in our community was in it. It's fizzling back a little bit now, but we're still of the view that this will perform rather well. Let's do 2 hourly for you. I'll give you a quick flick of the lights. So we are expecting 11 to be run. So let's just do this. So we're pivoting to a currency trade now. Currencies are going to be interesting. Many of you will say, oh, I'm just a stock guy. I understand only products. You know, I'm a retail guy. I understand an Apple device. I understand a washing machine, etc., etc. If you understand countries and how they do, this is the share price of a country in essence, in a simplistic form. And you had a good squeezy structure there. Let's use a better draw. Let's do it with a straight line. That did indeed make our targets there. A number of the community members were in it, and then it did it again. And this is giving us, we think the 11 should just be run. In fact, the target is about 10.9, and we shared that. You could have got in and around these levels, or on a second pullback, or even a touch sooner. You could have started with your stop over there, and you will have a reward up top at 11. So we showed you how Tesla, BMW had done, and a couple of other calls we'd made in the previous one. This was a live one that we were still in. So giving you a bit of a heads up on it. It's well on its way, but it got a nice little slap in the face there to slow it down. You're still going long the euro at the end of the day, and currencies can, they can be choppy, but going well, doing nicely and making money. What about China? So we talk about importing inflation. This is a very important cross for Americans and for the world as well, because what's good for America is good for all of us still to a degree. The USDC NH, Forex, in fact, I have it already. I don't know why I didn't find it. So we're going to have a look at this. We're going to go initially to the big time frames. So this was a difficult time for China in the 90s when they were trying to jump on the train. They were trying to find their level against the dollar, and they wanted probably some degree of export advantage so they could take all the business. However, more recently, that level that they chose is coming off. What does that mean? It means the dollar's losing ground. The dollar's losing ground. Now, many of you will say, oh, it's a manipulated market. How can you do technical analysis on a manipulated market? The manipulation is clear to see. A manipulator is just a big player with a bigger wallet than everybody else. So clearly there was a peg moment, and then they said they would leave the peg of 8.3. So when America was doing dollar destroying things, it benefited China because they just pegged to the dollar and said, don't blame us. And you may remember there was a period when Americans and presidents were accusing China of being currency manipulators. They said, well, you're trashing your currency and all we're doing is tying our truck or our trailer to your truck. And, you know, whatever you do, we do. It's just knock-on effect. So that was the hypocrisy of the West. And you can see another obvious level that was also holding a line in what was a loss of value of the dollar. Remember, the dollar is the first and the renminbi is the second. So this has all been appreciation of the Chinese renminbi, loss of the dollar. $1 was buying you less and less renminbi. Now, when you look at this technically, this is not a great technical pattern. It's more likely to go down. More likely to go down. That's right. We were saying, watch out for the dollar milkshake, and you're going to make 111. That's upside dollar strength. That's all happened. And this is all that happened on the renminbi. Renminbi was pretty strong during that period. It gave back a bit of ground, but look at this volatility. Every time it moved up, it got smashed back. Now you may say, well, that's manipulation. They just threw a lot of money in it. Well, people can't afford to do lots of money wasteful things all the time. People don't choose to burn money. So, there were some reasons maybe just beyond that. So we drop into it a little bit more, and we told you that there could in fact be a head and shoulders a while ago on the renminbi. There could in fact be a head and shoulders. That's a little bit too small. Let's go back to the daily. And that has indeed occurred and is virtually home. Can you see it with me? Virtually home, and we've got a grind line there. So what does this tell us? It tells me that I see a little bit more to come of the weakness of the dollar against the renminbi, which could also mean a little bit more of the weakness of the dollar against many things. So the euro might get 1.9, maybe get into 1.10s as part of it. Don't forget, we called that one short at 118 to parity, through the parity level. It traded 96 on the euro USD, and we called the parity run on the euro Swiss franc. That came first, even sooner. And then you got the dollar run. So this is what's happened. Now we're getting counter rallies. You've got to decide which is the core theme. Which is the core theme. At the moment, the euro strength feels like a counter rally to me, both against the Swiss franc and against the dollar. So it's a counter rally, but that would mean more weakness for the dollar and more gain for the yuan. That means when you are buying stuff made in China, it's going to get more expensive to come back in to America. America imports a whole bunch of stuff. Its exports are all things like services and, iPhones that are made offshore, etc., etc. Anyway, so those are things for you to consider. The Chinese renminbi. We drew this and said, as crazy as it sounds, because at the time it was quite a difficult thing to say, the dollar was running against everything else. It was running through the 111, went as high as 114 on the dollar index, now only at 102 after running 114. We said, but it looks like the dollar was going to lose value. Beautiful flag there, by the way. Technical analysis works, my friends. Down you go, and not much more potentially to go to run that target, which could mean a bit more weakness, but then maybe not too long after that, some signs of a slowing for a while. Okay, so that's the direction. So maybe J meets the expectations of 2.25%, doesn't do a super hawkish 50 basis points, although I do feel people are underpricing that possibility, and you get a little more weakness before you finally go. Okay, guys, I hope you found that useful. If it's nice to have updates, watch for all those big earnings coming in. The market could be volatile. It's actually best to wait for an earnings week to play out. Don't do anything skittish. Powell's going to speak. The market's going to swing like mad. If you have tight stops and you're putting on risky trades, guessing an earning or trying to guess the Fed or front run the Fed, you will be stopped out. Simple as that. Volatility could get high, not on the VIX so much. I still think the market is calm, but as the news is coming out, you could have light volume and skittishness, and your spreads could expand on your various platforms, and your liquidity providers to your brokers could be spotty. So you're just going to get hammered. Don't do it. Wait till the dust settles and contemplate your position. Then trade smart so that you can stay in the game. The rule number one of the game is staying in the game. Do not blow yourself up. You will learn this and more when you go to themarketsniper.com to book a call. Hope this was useful to you, and we'll catch you next time. Thanks for watching.